Welcome back to our Outlook 2024 series. We now have with us a veteran economist, the chief Asia Pac economist of Morgan Stanley, Chetan Ahya. Chetan, good morning. Thank you very much indeed for joining us, and a very happy 2024 to you. Well, will it be a happy 2024 in terms of growth? Now, one of the big fears in India is that even if the domestic economy ticks well, global growth won't oblige. What's mostly your view of global growth?
Yeah, so that's right, Latha. We are expecting that global growth will still remain soft, particularly for DMs. We are expecting growth to be softening over the next few quarters. And that's because, both US and Europe are still dealing with the lingering effects of that high inflation that they have seen in the past. Labor markets are still somewhat tight. So it's going to be difficult for central banks to ease monetary policy quickly to get that growth trend above trend or even close to last 30 years trend. So we're expecting global growth to be below last 30 years trend of 3.5% again in 2024. And similarly for DMs, we're expecting growth to be below that 2% trend that they had been seeing over the last 30 years.
Okay. Now, with that preface, let me come to Asia itself. First, China. Do you see it emerging out of its debt deflation loop? Do you see China being able to record a better growth than the current year, than 2023?
So we think on a real growth basis, China is likely to achieve 4.2% in 2024. Which would be very similar to what we achieved in 2023 when you do the base effect adjustment. So the headline will be 5.1, but the denominator was 3%, i.e. 2022 was 3%. So when you take the average for those 2 years, 2022 and 2023, that would be about 4%. And then 2024, we're expecting it to be 4.2. So not much improvement on real growth basis. But as you alluded to earlier, I think the bigger concern that we have for China is the underlying trend of deflation. GDP deflator for the fourth quarter of calendar year, i.e. last quarter, is estimated to be at minus 1.3%. And that would mean that you would have seen 3 consecutive quarters of China's GDP deflator below 1%. So that's extremely concerning development. And with that, their nominal GDP growth will be in the range of 3.5% for the last quarter, which is extremely weak. And when you ask about the outlook, whether we expect them to get out of this debt deflation loop risks, the key trend that we are watching now is what is going to happen to wage growth. So the corporate sector with this weak nominal GDP growth is under pressure. And when you are seeing that, weak pricing power, weaker top line, the only choice that the corporate sector has then is to start cutting wage growth, which is the biggest cost item for them. And we are seeing some anecdotal evidence of that emerging. So unfortunately, at this point of time, to the extent to which the policy response has not been aggressive enough, we still see that the risks of debt deflation loop are pretty much alive.
Okay. Now, before I come to central bank policy across Asia, one of the blessings of China growing slowly is that India's core inflation is low because there is a global deflationary, force. Do you think that will continue? Can India continue to enjoy low core inflation?
I think so. I think the key benefit that India will have on account of this sort of deflationary trend in China is that the goods component and the commodities segment will be supportive. And in fact, we are seeing this development globally that when you look at various countries' core goods component of CPI, that has been rolling over. In fact, even in the US, as we have seen recently, inflation numbers have been supportive, i.e. that they've been supportive for the central bank to be not concerned about inflation risks too much. That has been primarily because of the core goods component. So it helps global goods demand-supply balance to be in a way sort of brings down the overall inflation rate across the region. And at the same time, commodity prices are also remaining subdued. And China, as we know, is a big part of the commodities consumption basket for the world. And so I think that those are the two benefits that India will also see on account of weak investment growth trend in China.
Well, Chetan, with that, let me come well and proper to India. We got this eye-popping forecast from the NSO saying that, we can get a 7.3 in the current year. Do you endorse that? And does that want you to upgrade the coming year, the FY25 as well?
Well, no, we did revise our numbers in the past week when I was on this forum, and our India Economist would have been on your show. We referred or expected India's GDP growth to be at 6.5% for 12 months ended March 24. But with the recent quarter GDP data, we had already upgraded it to 6.9. And as of now, we are sticking to that. What appears to be the case is that CSO has taken the trend in the first half and then sort of assumed the same for second half. But there are some base effects coming up, especially in the quarter ended March 24. And so we think it would be right to just still keep it at 6.9 for 12 months ended March 24. And for the next year, we are at 6.5. So no change, Latha. Okay. I think 6.5% is still going to make India to be the largest, fastest growth, large economies in the world.
Okay. See, time permitting, I'm going to come back with a couple of India questions, especially on the budget. But before that, Japan, that there is the stock markets are at a 32-year high, and it's after 32 years that they have had a bit of inflation as well. Do you see that continuing? And more importantly, does that take away, therefore, both FPI and FDI flows, more importantly, FPI flows away from India as Japanese start investing in their home market?
Well, I think to the extent to which, there has been, less inflows into China, I think that's a big market. What we are seeing that investors are diversifying both into Japan and India. So I don't think there is a need to think about the fact that if Japan market is doing well, it will take away inflows from India. I think the issue for India is from particularly the equity market investors, not necessarily the FDI investors, but the equity market investors have been all just very still concerned about the valuations. And that has been a challenge. But on that front as well, we've seen that there has been a turnaround, especially in the last 6 weeks. Inflows have been quite meaningful. And that has continued alongside Japan. So, yeah, I don't think there is a sort of cannibalizing of flows because of Japan doing well.
Okay. Well, to come back to India, while the capex number, gross fixed capital formation, was very good in the CFO, NSO forecast at almost 11%, consumption has been a bother with just 4.4%. Do you see that becoming a problem? Companies not investing in capex because consumption is not good enough?
Well, actually, we have some early signs of consumption growth broadening out. So far, we did have that problem that, rural demand was still not very strong in the first half of the financial year, which is, again, remember that CSO is sort of looking more at the first half and then thinking about the second half. They're not assuming any sequential improvement because that's not generally what they do. But if you sort of look at the anecdotal evidence or even what the companies are saying for the rural demand, there has been pickup, especially in real volumes. I know that the nominal rural sales growth for FMCG companies has been still not that strong. But in terms of real numbers, there has been an improvement already for the rural economy in the December quarter. And at the same time, we are also seeing that improvement in sort of the consumer durable sales. Again, that's all anecdotal evidence. We'll see when the actual quarter's data comes for the December quarter. But we do see that there are early signs of consumption growth broadening out. And therefore, we are expecting that in the second half of the financial year, when we get that full financial year data for March 24 financial year, consumption growth will be at about 6%. Versus 4.5% that we've seen in the first half, which has been the basis for CSO's forecast for the full year, as they have said.
Okay, आपके मुंह में घी शक्कर. Now let me come to the rate question. When does the rate cycle cutting start in the US, and more importantly, from the Reserve Bank, because they're forecasting inflation to come to 4, but again rise in the fourth quarter above in the third quarter. Above the 4% mark, 4.5 or 4.7.
So we think that they will cut in June 2024. And as you know, there were two members of the Monetary Policy Committee which were highlighting that even on the basis of RBI forecasts, inflation will be below 5% over the next 3-4 quarters. And as that happens, real rates will rise. The question is whether, neutral real rate, is it closer to 1%, or has that gone up? Because we have seen investment-driven growth, and if RBI takes a view that real neutral rates have gone up, then they may sort of delay the rate hikes. But at this point of time, we think that if you assume that the framework is the same as what they had before, as you get to the point where inflation looks consistently below 5%, real rates will rise, and that's what we think will enable them to cut rates from June 2024.
Okay. Well, for the record, the Reserve Bank has been insisting a number closer to 4, but be that as it may, I guess their eyes will be also fixed on the budget, on the fiscal deficit. So that question to you, what are your expectations? What would be your ask from the budget?
Well, I think usually before elections, it tends to be a vote on account. So we'll see whether they do some active policy announcements or make it as a vote on account. But the ask is the same, is that keep that focus on capital expenditure, which has been nicely lifted up to about 19-year high if you see the last budget estimate. But I think that approach is working. What we are seeing, I know you mentioned about consumption growth being weak, but at this time, India needs investment-driven growth rate. And that's what will drive consumption growth on a sustainable basis. But then, because if you have that investment growth, then you get the job growth, and then it follows, consumption growth follows. So yeah, I think the ask from budget is to keep that focus on boosting public and private investment, because that's the only way you can have that strong compound annual GDP growth rate of 6.5 that we are expecting.
Okay. Thank you very much, Chetan Ahya, for telling us that consumption has indeed picked up, and that Indian growth doesn't slow much despite global headwinds. Most importantly, that the capex cycle has taken off and should continue in the budget. Thank you very much. Have a great 2024 yourself.
Thank you.
Okay.